John Paulson is a super shrewd investor, personally pocketing several $billion during the great financial crisis from his bets against subprime. Now, what is he doing? He just bought over $300 million worth of Bausch Health stock. BHC is the ticker. What's interesting is, as you can see here, his purchase price was around $9. This is a premium to where it currently trades at around $7.60. So BHC is the ticker. Just a few days ago, purchased a block around $9, a $300 million stake. Here's the chairman of the company with a history of creating a lot of value for himself and his investors, making another big bet on Bausch Health. I personally suspect making that purchase that's significantly above the market reflects his view that Bausch Health could have several 100% upside from here. So there is some sort of asymmetry in terms of what its potential. That said, I'm going to review Bausch Health, an overview in this video to understand sort of what is he playing for? What's the angle here? And if you enjoy educational investment content, my name is Daniel. You're watching Unrivaled Investing. Let's dive right in to understand, what does John Paulson see with Bausch Health? What is Bausch Health? Let's go through it. And this is not his first purchase as the chairman of Bausch Health. You can see there have been several purchases, 10 days ago, 2 months ago, where, it's tens of millions of dollars. He's been scaling into it. So they did put out a press release, because he is the chairman of Bausch Health, saying that, they were buying their stake from Carl Icahn, another notable investor. This bumps up Paulson's stake to around 19% of the company. The Icahn members, they're resigning from the board of directors. And John Paulson saying, look, I think there's significant value here in Bausch Health, and he's looking to maximize shareholder value. Clearly, Carl Icahn wanted more than the current share price of around $7.60, and he was able to get $9. So and John Paulson was happy to pay for it. So this is an interesting dynamic. John Paulson wanted that block now. He's willing to pay a premium for it because the stock's currently $7.60 versus the $9. That means he clearly thinks there's a lot of upside potential beyond this. And he also has a track record, investing in a lot of different, specialty and generic pharma companies. His prior exposure was with Valiant purchasing Salix, Allergan to merge with Shire, and Mylan purchase or making a hostile bid for Perrigo. So there's a lot of, apologies if I massacre the pronunciation, but he's had a lot of exposure to this space. This is not his first runaround, in it. If you're not familiar with Bausch Health, as I was just, until about a day ago, Bausch Health, as I'm looking at it, this actually has a company that's tied to Valiant. So this is actually formerly Valiant. Valiant's the company that was forced to restate their financials. They had to pay tens of millions of dollars to the SEC because of misleading disclosures. The CEO and CFO sort of were tarnished. They sort of manipulated their financials with a segment that was driving their sales that wasn't, that they effectively subsidized. And this was the same Valiant that Bill Ackman lost nearly $4 billion on. So there's certainly quite a history here with Bausch Health. I mean, they've gotten a new CEO, I think a whole new management, change of names to get rid of the tarnished Valiant perception. But clearly, a lot of investors over time have looked at this entity and said, there's a lot of potential cash flow from these assets. So let's understand what's going on here. Let's see what John Paulson sees, in Bausch Health, now formerly Valiant. When I check with Flash, that's my free AI assistant. Check the link below. It's it's free for you to use. It says, the quality here isn't that great. This is a 5.5 out of 10. It does have some potential health concerns that you're going to want to look into, and that absolutely makes sense, because when we look at it, this company has a lot of debt, and how they talk about how they have around $16 billion of debt. This excludes their Bausch and Lomb debt. And, it's important to understand $16 billion in debt in Bausch Health, BHC, the ticker, versus a market cap of around $2.8 billion. So this is extremely heavily leveraged entity. If you were to, and this is red flag number one for me personally, I do not like to buy entities or invest in situations where the market cap is significantly less than the debt. That means most of the value is currently held up in the debt. You could have that does mean you could have explosive, upside potential, but that can be a red flag that, hey, if there's a situation and there's any sort of wiggle in the results where, profitability declines, that debt would be the owner and the equity gets wiped out. I do not like to invest in situations where you have that type of, here's the equity and here's the debt. Boom. A lot of value being tied up in the debt. And also means you're a heavily leveraged entity. If interest rates go higher, you need to be mindful of that. If you need to be mindful of when are your debt repayments, it doesn't look like from a timetable perspective, looks like the nearest bullets are around 2028. So you do have some time, but that's $4 billion that looks like needs to be considered in just a couple of years. So some breathing room in the next 2 years, but $4 billion is quite a bit. Once again, using Flash to help me understand, get up to speed on the company. There's definitely a lot of moving pieces here because they previously had this strategic restructuring where they're thinking about spinning off or separating Bausch & Lomb. And so what they did is they took Bausch & Lomb public via an IPO in 2022, and they still hold around 88% of Bausch & Lomb. So you have Bausch Health, BHC, and then there's Bausch & Lomb, which is BLCO. And this is where it's interesting because BLCO at $15 publicly traded has a $5.3 billion market cap today, and 88% of which is owned by Bausch Health. And this is what Paulson is investing in. Why is he investing in it? Because this 88% stake is worth $4.7 billion. So that's nearly 70% more than Bausch Health's current market cap. So you have this really interesting situation. Billionaire investor buying a company trading arguably below its liquidation value. You can, size that up just because, you're looking at the stake in Bausch & Lomb. We'll talk about how the debt and all that, the potential EBITDA, sort of flows through it. But these are interesting dynamics. When you're like, you own 88% of a stake and that stake is worth more than your current market cap. That means the market is concerned about your debt and your operations outside of Bausch & Lomb. So this is very interesting dynamics that is going on here. Immediately, you could see that there could be a lot of upside if Paulson is right. When we look at Bausch & Lomb, this is really an eye care company across various different products, vision care, surgical, pharmaceuticals. It's all, as far as I can tell, it's largely tied to eye care. And Bausch & Lomb also, this is a company structure that is not shy on debt, because not only did you have this, sizable $16 billion debt with Bausch Health, you also have $5 billion at the subsidiary level on top of that. So a lot of debt. So that's BLCO for Bausch & Lomb. And so maybe, thinking about this, maybe this is John Paulson's bet saying, I'm expecting, President Trump to put in a new Federal Reserve chair that's going to dramatically lower rates, and it'll make it easier for Bausch Health to refinance and maybe squeeze their profits higher. Maybe that's an angle that's going on. Clearly this is a very, very leveraged play. And it's also interesting to look at this because, once again, Bausch Health, which is what Paulson just invested $300 million plus in, $2.8 billion market cap, versus their Bausch Health companies, excluding Bausch & Lomb, which they own 88% of. They're saying they're guiding for this year around $800-900 million in operating cash flows. Let's say, let's assume around $100 million in capital expenditures, ballpark. And so you're talking about a company that's Bausch Health, excluding their 88% ownership of Bausch & Lomb, generating around $700 million in free cash flow. That's their ballpark figure here. That's what I'm estimating based on their guidance. And so you're saying this is an entity that's trading around 4 times free cash flow. So this is another angle in which John Paulson is seeing the value. So, sort of looking at the pieces. So you have Bausch & Lomb, BLCO, $5 billion value approximately to Bausch Health. You also have non-Bausch & Lomb, entities or assets that are generating around $2.7 billion in EBITDA. That's from this. This is once again, this is what I'm focusing on, which is they own this. This has around $5 billion in market value. Then they have this other portfolio that's generating around $2.7 billion in EBITDA or around $700 million in free cash flow. And so $5 billion in their asset, $2.7 billion EBITDA versus around $16 billion in Bausch Health debt. And so thinking about this, if you could have some sort of multiple reversion, where it goes higher and you get 8 times, not a crazy high multiple, but 8 times for their core business of $2.7 billion, you net out, you add this $5 billion, subtract the $16 billion to think about the equity value. And you're talking about, potential equity value of, let's say, $10, $11 billion or $28 per share versus $7 to $8 today. So that's largely how I think he's playing for it. And I think this is the classic John Paulson take, which is if you can find these asymmetric bets, even if it doesn't work out, your downside's 100% if it doesn't work out, but your upside can be several 100%. And I think that's what he's looking at here, saying, yeah, this is another one of those types of bets that, heads, he's okay losing 100%. That's not something that I look for on my personal investment journey. But he's clearly looking for things that have that type of potential. And I think that's what he's looking at here. I think he's saying, and that's part of the reason, like, why would you as an investor be willing to say, yeah, I'm willing to buy a block, when the market's at 760, yeah, I could slowly get into it, or I could just buy a block at 9. The reason why you'd be willing to do that is because you suspect that the share price might be 20 to 30 at some point in the future. That's what I suspect is going on here, that he's sort of playing for. So, as we think about this, what are my personal conclusions? Because I don't own any Bausch Health, at this point. I just want to sort of start walking through the thesis with you. What are my thoughts from here? First of all, none of this is financial advice. I don't own a stake in Bausch Health. And also, just quick plug, Shaka, a premium subscriber, wrote, I'm a member of your premium service 2 years running. Always enjoy your take on stocks and broader market. After joining, I was able to recover part of my loss during 2022 crash, but the most rewarding aspect of this journey was a sense of stability that I was able to bring about with the help of your services. This follows Michael, who said, so far the subscription has paid for itself in 3 months. Looking forward to what the future holds. If you're looking for compelling ideas, now is the time to come check out Unrivaled Investing. So thinking about Bausch Health, you have, BHC is the ticker. You have, and this is my checklist. This is, I keep coming back to it. I believe that if I stick to this checklist, it helps increase my odds that I'm going to find and invest in favorable sort of outcomes. Nothing in investing is guaranteed, but I feel like having a checklist that you can, stick to increases your odds, makes it more favorable. So the first is aligned management. Yeah, I would say, you have that component when the chairman just bought $300 million and was previously buying tens of millions of dollars, and he's buying a premium to the current market. So aligned management, check. John Paulson, he's going to try to figure out how to squeeze value out of this. Compelling valuation. Yeah, I think between trading at a discount to its Bausch Lomb stake or thinking about the cash flow that it generates, excluding Bausch Lomb, that it's roughly 4 times that equity to that free cash flow multiple. Now, there's a lot of debt involved. That's the challenge. And there's a lot of sensitivity that's going to be to interest rates, to paying down that debt. So then it leaves these 2 other aspects of, my checklist. It's questionable whether or not you have the win-win dynamics, because what got Valiant in trouble was they would buy these new drugs, or they'd buy a treatment that was available on the market, and then they'd jack up the prices. And that's clearly not a win-win for society, win for shareholders. That's largely what got the ire of the public officials looking at Valiant. And then you had short reports saying, yeah, you have these misdeeds, which they did, and they, paid tens of millions of dollars for. So the win-win, that's another sort of, need to think about that. But looking at let's focus on these two, the growth potential and no blow up risks or limited blow up risks. That's because that's a key part of my portfolio. I don't like investing in things where I could say, yeah, this is there's a key aspect that can really tank the business. And generally, blow up risks come from three different areas, in my opinion, as an investor. The first is you overpay for something, dramatic overvaluation. That is a type of blow up risk. I don't think you have that here necessarily. I think it's on the cheaper in terms of valuation, but there are blow up risks. So I don't think valuation is one of the blow up risks. Another type of blow up risk is various different types of business risks. That might be customer concentration. That may be supplier or platform concentration. So that's, business type of risk. So we're going to talk about that in a second because we haven't really talked about what does Bausch Health do. We've talked very briefly about Bausch Lomb being an eye care company that's their stake's worth $5 billion roughly on the market. So you have uncertainty in terms of the business risk, but you clearly have this debt risk. And so that is automatically, this is in the yellow-red territory for me. Like, I'm not sure I'm going to be able to pull the trigger on that, just that amount. But look, John Paulson's a very shrewd investor. He's looking for these types of bets where you could have several 100% upside and you're still sort of, you might have 100% downside risk. And so those are the two that I think need to get focused on, the blow-up risks and the obvious growth potential. Given that the blow-up risks, in my opinion, are very real, it comes down to the growth potential. So let's see what, comes there. And so understanding the business, you have a couple of different pieces here. And this is, once again, this is Bausch Health, excluding their 88% owned Bausch Lomb. So looking at their profitability in the second quarter, you can see the vast majority of their profits came from the subsidiary Salix. You can see that it's also their biggest revenue driver. It's also, from a revenue perspective, it seems to be driving, growing at a good clip versus the other subsidiaries. When you're looking at a profitability standpoint, the other subsidiaries, two of which were declining, the smallest was growing. So it really is Salix that's driving the show here, as we're looking at it and thinking about what's driving Salix. What actually is, what does that even do? That is predominantly 80% plus a product, Xifaxan, I think is how you pronounce it. So that's 80% plus of Salix. So now you're talking about product concentration that's driving Bausch Health. You have Bausch Lomb and you have Xifaxan. So that's how I'm thinking about it. And, so this is something that I think treats IBS, irritable bowel syndrome, or type of IBS and type of diarrhea drugs or traveler's diarrhea or something like that. And this is another, I'm sort of iffy here because what makes me concerned when you have product concentration is, do you have some sort of patent cliff where then generics can come on board and then your profitability collapses significantly? And here it is. This has been a product that has seen a lot of litigation. And they're calling out that Xifaxan faces a patent expiration in October 2029. So you're really talking about in 2030, potentially a huge impact to their profitability. So that is a few years where they're generating meaningful free cash flow, possibly, $800-700 million alone from their health portfolio. But this is I think this is the final straw that makes this a little too hard for me. Is I don't like dealing with lots of debt and product concentration like this, where you have this patent that could be going off a cliff. I think there are easier bets out there. I do like to see this management alignment. I do like to see him making this purchase. And it wouldn't surprise me if it works out for him. Wouldn't surprise me if it's a $20, $30 stock in the future. It just makes me a little too uncomfortable looking at the combination of, large debt, portfolio or large debt amount that needs to get repaid over time, sensitivity to interest rates, arguably going lower interest rates, but who knows, likely going lower in the immediate term. And then you have some sort of product concentration. So I'm looking at these dynamics, makes me a little too uncomfortable. So it's probably going to be a pass for me for now. But if you have a different take, would absolutely love to hear it on Bausch Health stock. I'd love to read your comments below. And thanks so much for watching Unrivaled Investing.